This show is part of OnePlace, a daily network of focused briefings across the stories people follow most.
Welcome to the briefing. We are diving into a massive funding round for OpenAI, the strain on Social Security, rising grocery bills, and how global markets are reacting to the latest geopolitical shifts.
OpenAI secures a massive $122 billion investment.
Social Security faces staffing crises and long beneficiary wait times.
Food prices may soar 10% due to regional conflict.
Economists weigh the risks of a potential United States recession.
Global stock markets rally on hopes for a war resolution.
Startups offer fractional homeownership to help cash-strapped buyers today.
Asian stocks surge following optimistic comments from the White House.
Okta CEO advocates for a kill switch on AI agents.
Meta assembles an elite lab to revolutionize its recommendation algorithms.
United Kingdom consumer confidence drops as mortgage rates remain high.
First, OpenAI's massive news. OpenAI has just closed a staggering $122 billion funding round, bringing its valuation to $852 billion. This cements the ChatGPT creator as one of the most valuable private companies globally. Major players like Amazon, Nvidia, and SoftBank led the charge, contributing the bulk of the funds. This massive influx of capital comes at a critical time as the company prepares for a highly anticipated initial public offering later this year. Despite the eye-popping numbers, OpenAI is still facing significant hurdles, including multiple lawsuits and intense competition. They are also burning through cash, with internal forecasts suggesting they won't see a profit until at least 2030.
It is a bold move, especially after they recently shut down their Sora video platform and ended a billion-dollar partnership with Disney. To keep the momentum, OpenAI is pivoting toward a unified AI super app. This would centralize ChatGPT, their coding tools, and new semi-autonomous AI agents that can act on a user's behalf. While they are generating $2 billion in monthly revenue, the scale of their losses is equally massive. This funding gives them the runway to continue leading the AI boom, even as skeptics question if the industry is in a bubble. They are essentially betting that their technology will eventually drive enough productivity to justify these astronomical investments.
Next, Social Security's struggle. The Social Security Administration is currently reeling from a severe staffing crisis that was exacerbated by recent cost-cutting measures. Before the Department of Government Efficiency, or DOGE, began its work, the agency was already at a 50-year staffing low. The subsequent reduction of about 7,000 workers, which is roughly 12% of their workforce, has left the remaining employees completely overwhelmed. We are hearing reports of staff skipping breaks and working long hours just to keep up with the paperwork. This is happening right as the massive baby boomer generation reaches retirement age, creating a perfect storm of high demand and low capacity. It is a stressful time for everyone involved.
The impact on beneficiaries is deeply concerning. Many of the 74 million Americans who rely on these checks are facing longer wait times and uncertainty about the fund's insolvency. Retirees living on tight budgets are worried that any further disruptions could jeopardize their livelihoods. While the agency claims that new technology is being implemented to improve customer service, the immediate reality on the ground feels much more precarious. Union leaders have described the situation as the tip of the iceberg, warning that employee burnout is reaching a breaking point. For seniors who depend on this income to survive, the ghost of these budget cuts continues to haunt their financial security and peace of mind.
Now to food inflation. Grocery shoppers are facing another sharp rise in costs, with food prices expected to soar by nearly 10% this year. The Food and Drink Federation has significantly hiked its inflation forecast, citing the ongoing Iran war as a primary driver. This conflict is causing fuel and energy bills to bite, which in turn pushes up the cost of manufacturing and transporting food. For the average household, this could mean an extra £588 added to their annual grocery bill. It is a tough blow after the high inflation seen in 2022 and 2003. Even though prices had briefly stabilized, this new wave of inflation is expected to hit hard in the second half of 2026.
The situation is being described as unprecedented and very difficult to predict. Chancellor Rachel Reeves is scheduled to meet with major supermarket chiefs from Tesco and Sainsbury's to discuss how to mitigate the impact on consumers. Some retailers are calling for more government support to handle the constraints being placed on businesses. When you look at the numbers, a weekly shop that cost around £119 could soon jump to over £130. This puts a massive strain on families who are already struggling with the cost of living. The ripple effects of the conflict in the Middle East are being felt directly at the checkout counter, making basic necessities much more expensive.
Moving to recession risks, Economists are keeping a very close eye on whether the United States is headed for a recession, especially with the Iran war complicating the economic landscape. While the country isn't officially in a recession yet, the spike in oil prices and disruptions in the Strait of Hormuz are major red flags. Experts like Claudia Sam note that while there are reasons to be concerned, we haven't seen the consistent negative indicators required for an official declaration. Job growth has slowed down, and manufacturing activity is showing some signs of cooling, but consumer spending has remained relatively resilient so far. The key factor will be the duration and severity of the conflict, and how it impacts global trade and energy costs.
Even if the technical definition of a recession isn't met, many Americans aren't feeling great about the economy. Real personal income growth has been fairly stagnant, and the surprise decline in employment in recent reports has added to the unease. The National Bureau of Economic Research takes a long time to make official calls because they wait for sufficient data, but the public's perception is often shaped by immediate costs like gas and groceries. Some economists argue that the economy still has forward momentum, but the risks are definitely tilted to the downside. It is a delicate balance, and any further escalation in the Middle East could be the factor that finally tips the scales toward a downturn.
Next, global market reactions. There is a glimmer of hope in the financial world as oil prices have retreated and stock markets are rallying on news of a potential resolution to the Iran conflict. Brent crude fell back below $100 a barrel after President Trump suggested the war could be over within 2 weeks. This optimism sparked a significant rebound in the FTSE 100 and other major European indices, which saw gains of over 2%. Investors who had been sitting on the sidelines with a mountain of cash finally saw a trigger to put their money back to work. However, market analysts warn that the damage to the region's energy infrastructure will take years to repair, even if a ceasefire is reached soon.
While the markets are reacting positively to the diplomatic signals, the situation on the ground remains volatile. Iran recently hit a tanker off the coast of Qatar, reminding everyone that the Strait of Hormuz is still a major flashpoint. About a fifth of the world's oil passes through that strait, and its partial blockage has already sent prices up 50% since late February. Even if the fighting stops, Iran is planning to implement tolls on ships, which will keep freight costs high. So, while we are seeing a relief rally today, the long-term economic consequences of this conflict are far from over. Investors are hopeful, but they are also remaining cautious given the underlying instability in the Middle East.
Shifting to housing trends. In many major cities, the cost of land has become so high that traditional homeownership is out of reach for most people. In Los Angeles, for example, the land itself can account for over 60% of a home's value. This has led to the rise of fractional ownership startups like Jubilee Homes. Their model allows buyers to purchase the physical house while leasing the land underneath, a practice known as a leasehold. This is common in places like the UK and Singapore, but has remained a niche concept in the United States until now. These startups pitch themselves as a way to add rungs to the property ladder, helping people build wealth in a home they can actually afford.
However, housing advocates are urging caution. The Consumer Federation of America warns that if a deal sounds too good to be true, it probably is. Homeowners in these fractional deals might still be responsible for all the maintenance, insurance, and property taxes, while the investors take a large share of the home's future appreciation. There is a concern that buyers might not fully understand the financial trade-offs they are making. Despite these risks, the extreme difficulty of entering the housing market today means we will likely see more of these unorthodox models. It is a creative solution to a massive problem, but it requires a lot of scrutiny from consumers before they sign on the dotted line.
Now, Asian market surges. Asian stock markets saw a massive jump on Wednesday, following comments from the Oval Office. President Trump stated that the United States would exit the war with Iran within 2 to 3 weeks, regardless of whether a formal deal is reached. This news sent South Korea's Kospi up over 6% and Japan's Nikkei up 4%. Investors are desperate for any sign that the month-long conflict, which has severely disrupted global energy markets, is coming to an end. Even with these gains, many of these indices are still trading below their pre-war levels. The rally reflects a collective sigh of relief, but analysts point out that the underlying geopolitical uncertainty hasn't been fully resolved yet.
The president's rhetoric was quite blunt, telling allies to get their own oil and suggesting that other nations should take control of the Strait of Hormuz. While this signaled a clear exit strategy for the U.S., it leaves a lot of questions about the future stability of the region. Oil prices remained somewhat elevated despite the stock rally, with Brent crude still hovering around $105. The volatility in energy markets is keeping everyone on edge, as any sign of re-escalation could quickly reverse these gains. For now, the markets are choosing to focus on the potential for de-escalation, but the path forward remains complicated by the macro fundamentals and the ongoing tension in the Gulf.
Next, AI security concerns. Okta's CEO, Todd McKinnon, is sounding the alarm on the need for a kill switch for AI agents. As businesses increasingly deploy these semi-autonomous bots to handle workflows and access sensitive data, the risk of them going rogue becomes a serious concern. McKinnon argues that companies must have the ability to instantly revoke an agent's access if something goes wrong. He describes these agents as a new class of digital workers that can move data and take actions across a company's entire software stack. Without strict parameters and a way to pull the plug, these agents could create massive new attack vectors for hackers. Okta is positioning itself as the essential security layer for this new era.
The proposed framework for a secure agentic enterprise includes real-time enforcement of permissions and human approval for any risky actions. It is not just about stopping the AI entirely, but about minimizing its access to sensitive systems the moment a threat is detected. This idea is gaining traction beyond just the tech industry. Even some regulators have proposed bills that would require firms to build in these kinds of fail-safes. As AI agents become more integrated into our daily work lives, the balance between productivity and security becomes paramount. Having a big red button might be the only way to ensure that these powerful tools don't end up causing more harm than good in the long run.
Moving to Meta's lab. Meta is quietly assembling an elite team of AI researchers to supercharge the algorithms that power Facebook and Instagram. This new unit, known as MRS Research, is focused on leapfrogging current recommendation systems to keep users engaged for longer. They have been aggressively recruiting top talent from competitors like TikTok, Google, and OpenAI. Leading the effort is Yang Song, a former TikTok executive who specialized in user growth. The goal is to use cutting-edge AI to optimize the home feeds and improve the performance of Meta's advertising division, which remains the company's primary source of revenue. It is a clear sign that Meta is going all in on AI to maintain its dominance in the social media space.
This reorganization happened late last year, but is only now coming to light through job listings and executive moves. By bringing together world-class engineers and researchers, Meta hopes to revolutionize how content is delivered to billions of users. They are not just looking for incremental improvements. They want to fundamentally change the recommendation engine. This push comes at a time when the competition for AI talent is fiercer than ever. Meta has been on a massive hiring spree since last summer, even launching other specialized labs to focus on superintelligence. It is all part of a broader strategy to integrate AI into every facet of their business, ensuring their platforms remain the most addictive and profitable in the world.
Finally, UK consumer confidence. In the United Kingdom, consumer confidence has taken a significant hit, marking the biggest drop since the start of the trade wars a year ago. People are feeling increasingly gloomy about their household finances and job security as the Middle East conflict continues to weigh on the economy. A recent survey found that the index dropped nearly 3 points in March, reaching its lowest level in over a year. While mortgage rate hikes have paused for the moment, the damage from previous increases is already being felt. The average 2-year fixed rate is now significantly higher than it was at the start of the month, adding thousands of pounds to the annual cost of a typical home loan.
The impact on borrowers has been almost immediate. Analysts point out that even the lowest available mortgage rates have jumped sharply, adding roughly £150 a month to a standard loan. This sudden increase in borrowing cost is forcing many families to rethink their spending habits. While some lenders are starting to bring back products they withdrew at the start of the conflict, they remain very cautious due to the uncertain future of inflation and interest rates. For many in the UK, the combination of rising grocery bills and more expensive mortgages is creating a very challenging financial environment. It is a stark reminder of how global events can have a very personal impact on everyday lives.
That wraps up our briefing for today. Thank you for joining us for these top stories.
Be sure to follow us for your daily update on the news that matters most. We will see you back here tomorrow.